I think the bond market is now probably slid into a bear market. And bear markets for bonds last for a long time. So do bull markets, by the way. We've been in a bull market for bonds, since the early 1980s. Actually, it's now just ended. So what did that entail? That meant since the early 80s, on a long-term trend basis, interest rates down, 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 down. Now, with a bear market, that suggests that interest rates will be either stable or going up. So they talk about interest rates will be higher for longer. They might be higher for a lot longer.
U.S. producer prices fell by the most since April 2020. Could this signal the beginning of the end of high inflation? The producer price index fell by 0.5% in October, while core CPI remained stable from September to October, but rose 2.4% year on year. Now, I'm using the Vantage plan on Ground News for my news source on this story today. Ground News is an app and website that provides a unique way to read multiple perspectives on the same issue at one time. It does this by aggregating news articles from various sources across the political spectrum, which is why I'm excited to have them as a continued sponsor. As you can see in their newsroom section, there are over 30 sources covering the story, and 58% of them are from the center, from sources such as CNBC and MarketWatch. Because Ground News is an aggregator, I can easily read multiple sources, in this case, another one being Bloomberg, for example, to get a different report and additional stats without having to search for them on Google. To search for articles you're interested in, simply go to the search bar, type in inflation, economy, or business, and you'll be presented with pages that give you the top stories of the day for those topics. Now, if you subscribe to the Vantage plan, you'll get 40% off unlimited access during their biggest sale of the year by going to ground.news/David Lin with the link down below. And now let's hear from Professor Steve Hanke on the economy. Renowned economist Steve Hanke joins us once again. He is the professor of applied economics at Johns Hopkins University. Welcome to the show. Welcome back, Professor Hanke.
Good to be with you, David.
I want to talk to you about this working letter that you wrote in response to a letter that was signed by a lot of economists opposing Javier Milei's plan to dollarize the Argentinian economy. But first, let's talk about, let's just recap this week's economic data in the U.S. So inflation, as you know, the CPI came down. Both headline and core came down. Headline CPI now at 4%. That's core CPI at 4%. Headline CPI at 3.2%. So a bit of a reprieve from the previous month. This is still in line with your projections. So can you please recap what you're projecting for inflation for this year?
Okay, this year, John Greenwood and I, using a quantity theory of money, forecast some time ago that we'd be between 2% and 5% by the end of the year. And as you said, the headline's 3.2. We got a couple months to go. It's pretty clear Greenwood and I have hit the bullseye again on this. Remember, we were the first and only ones to indicate where inflation was going when it was going up. We said it might go up to 9%. Well, in June of 22, it peaked out at 9.1%. So we hit the bullseye there. And now on the downside, we predicted that given the big contraction that we've been witnessing in the money supply, that with a typical lag, we will see inflation coming down. So we have it this year, 2 to 5%. Next year, 1 to 2%.
Okay.
1 to 2% for next year. So it's on a downward trajectory.
Did you see any external shocks that may surprise to the upside? For example, do you see the war in Israel, for example, causing any disruptions or potentially adding to inflationary pressures through energy or other sources, perhaps?
No, because inflation is always and everywhere a monetary phenomenon, and the causation for the existing inflation or the inflation that's coming in the next few months is already baked in the cake, because that was due to what was going on with monetary policy a year or 2 years ago. So this is this problem with this data dependency. People look at current data and they think it has something to do with current monetary policy. It doesn't. It's all caused by past monetary policy. And there are these long and variable lags between changes in the money supply and changes in economic activity and changes in prices. So that's where people get confused by the thing. And it's what can I say? I mean, they're looking at what they call financial conditions indices, for example, which are rubbish in a way, because those are the effects of what caused them to change, which is caused by changes in the money supply in previous months and years.
And the Federal Reserve has no plans yet to stop its quantitative tightening program?
No.
Okay, so we can expect, basically what you're saying is we can expect a further contraction, or at least no growth in the money supply in the foreseeable future.
That's the way I see it, unless the Fed changes course. And I think the only two things that will cause that ultimately, this contraction in the money supply will induce a recession this year. That's pretty much baked in the cake. And when that happens, the labor market, it's already starting to get weaker, but it will become obvious that it's weaker, and the Fed will then pivot. But that'll be kind of a slow pivot. The other thing that might cause them to a fast pivot, if for some reason there was a financial flare up on Wall Street caused by this contracting money supply, if there was really a serious credit squeeze and things became unstable on Wall Street, the Fed would then pivot pretty fast.
On Thursday, jobs numbers came out. Speaking of a recession and speaking of a slowdown, I'll just read you a paragraph from Reuters. The number of Americans filing new claims for unemployment benefits increased to a 3-month high last week, suggesting that the labor market was gradually cooling, in another boost to the Federal Reserve's fight against inflation. So some numbers here. Weekly jobless claims increased 13,000 to 231,000. Continuing claims also rose by 32,000 to now 1.865 million. Professor Hanke, the unemployment rate for the last month is now at 3.9%. Is there a particular threshold after which you would see unemployment is indicative of us being in a recession, or do you not look at unemployment as a gauge?
Well, the question is, what's the threshold that the Fed is looking at for this labor market? And there, as you just went through, one number is headline unemployment, but there are lots of other indicators of what's going on in the labor market. So you got to look at the whole thing. And when you do, you see weakening across the board. The headline number of unemployment doesn't look all that bad, by the way. It looks, you know, it's gone up a little bit, but it looks pretty good. So a lot of people conclude, well, the labor market's quite strong. That's not my take on it. At the margin, things are getting weaker. You see that a lot of the jobs actually are just being created by the government. They're not in the private sector. So that's one thing. Part-time work is a problem. Revisions down in the employment and labor market, they're all revised down. The past data that looked great is not quite so great once these revisions are taken into account. So everything's kind of ratcheting down and starting to slow down in the labor market. But that's consistent with the idea that if you contract the money supply big time, like we're doing, it's never contracted this rapidly since 1933. It's contracting now, a year-over-year rate of 3.7%. And bank credit is also contracting. Bank credit is contracting at about a little over 0.5% on a year-over-year basis. So bank credit contracting, overall money supply contracting, and that's a formula for what? It's a formula for economic slowdown and inflation slowdown, and that's what we're seeing.
Yeah, so inflation is slowing down. I have heard another argument for why inflation over the medium or perhaps long term could revise upwards, and this is the argument, and this leads to our next part of our discussion about debt. As you know, the current amount of U.S. debt, federal debt, is now above $30 trillion. From a debt to GDP perspective, it's the highest level since World War II. This is one argument I've heard. The government will have no choice but to monetize the debt going forward, which is to say they'll have to increase the monetary base, which will bring back inflation. Does that make sense to you?
Well, if they monetized it, we'd have an increase in the money supply and an increase in inflation. That's what we had with the COVID after February 2020, David. We had a huge explosion in the fiscal deficit. It got up to almost 20% of GDP, the deficit, and a little over 90% of that deficit was monetized by the Fed because the Treasury. Now, how does that happen? That happens because the Treasury sells the bonds they issue to finance a deficit to who? To the Federal Reserve. The Federal Reserve's balance sheet expands as a result. The money supply expands as a result because the Fed is issuing credit to the federal government. So if they did that would be one scenario. The other scenario is that the federal government continues to spend, the deficit goes up, which it is going up. It's forecast to continue to go up. And instead of selling the bonds to the Fed, they sell the bonds to the non-bank public. And in that case, you don't get any inflation because you don't increase the money supply. They sell bonds to Hanke and Lynn, and we demand a little higher interest rate. If we're buying those bonds, we're demanding a little higher interest rate. So the interest rate stays elevated, but the money supply doesn't go up then at all.
So if the interest rate stays elevated and the notional value of debt keeps going up. So this is a projection from the CBO, the Congressional Budget Office. They're projecting by 2033 the national public debt to reach $50 trillion. It's currently just above 30, like I mentioned. So that's an increase of $20 trillion in the next 9 to 10 years. Suppose this forecast turns out to be correct or in line with reality. Can the government sustain their interest payments or afford interest payments on $50 trillion of debt is my question.
Well, this gets to a real problem, and that is that the level of debt, the stock of debt has gone up tremendously since the COVID pandemic in the United States, and the interest rates on that debt have also gone up. So to refinance it, it costs more and more every time you have to do any refinancing. It's at higher interest rates. So that's a deadly 1-2 punch that is now has the interest payments as a percent of the total budget up around 15-16%. So that means the taxpayer is paying taxes, but about 15 or 16% of that tax payment, it's going for nothing. I would argue most of it's going for nothing, but we know 15 to 16% is going for nothing because it's just paying interest. It's not, you're not buying anything. You're not getting anything in exchange for 15 to 16% of the taxes you're paying. You're just paying somebody interest on it, on the debt.
Yes. Well,
so
does the government
this is a real problem, and you have that CBO projection of adding, $20 trillion to debt. Now, this is one reason behind my view that I think the bond market is now probably slid into a bear market. And bear markets for bonds last for a long time. So do bull markets, by the way. We've been in a bull market for bonds, since the early 1980s, actually. It's now just ended. So what did that entail? That meant since the early 80s, on a long-term trend basis, interest rates down, 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 down. Now, with a bear market, that suggests that interest rates will be either stable or going up. So they talk about interest rates will be higher for longer. They might be higher for a lot longer.
What does that mean for fixed income holders? Should you sell or should you collect the income?
It means you don't want to be buying a long-term bond and putting it in a safety deposit box. That's for sure.
Right.
Because you'll lose money. It won't be like the good old days when you were buying a long-term bond in 1985 and put it in a safety deposit box, and you made a hell of a capital gain on the thing, as well as the interest you were being paid.
But you could hold treasuries, I suppose, and collect higher interest income on that.
No, you're in a bear market. You're losing capital value all the time. If interest rates are going up, the value of the bond's going down.
I see.
So that as an investment in a bear market, are investments good, David, in a bear market, or bad?
Well, I'm just thinking from a passive income perspective, you're probably collecting more coupons, but then your argument that the value of the bond itself is going to drop. That may
the value of the bond itself is going down. So in bear markets, you don't want to buy. You want to be you want to stay away from them. So that's as an investment. As a trade, by the way, I think there'll be a lot of opportunities in this bear market for little bull market rallies. We've even seen that in the past week with the 10-year treasury. And so you can trade the bond from the long side, but you don't want to be investing in the bond on the long side in a bear market. If my conjecture about the bond market slipping into a bear market is correct, you don't want to be investing long-term in bonds. You might want to be trading them from the long side, however. And the reason for that is that people don't fully appreciate and anticipate how inflation is falling. We talked about you got to be careful. A lot of things are going on here, a lot of moving parts.
Yeah. Well, if we're entering final question on the markets, and I want to touch on your working paper. If we're entering a bear market for bonds, does that present opportunities for other asset classes, Professor?
Yeah, it could present an opportunity. Instead of buying the 10-year bond, maybe the best thing to do is buy a little gold and put that in a safety deposit box. As an example. But okay. in general, by the way, if we're talking about interest rates being higher for longer, a lot longer, this does tend to put pressure on PE ratios and bring those down to earth, because you're discounting free cash flow at a higher interest rate. If interest rates are going to be higher and you're discounting free cash flow at a higher interest rate, that suggests that the PE ratios will maybe come down to earth a little bit.
Okay.
And it could even be worse than that, by the way, because Greenwood and I wrote a few weeks ago in the Wall Street Journal that with the contraction in the money supply. It's all about the money supply. And with the contraction in the money supply, you could end up with a credit crunch type of situation hitting Wall Street. And we're right back to October 1987. Remember Black Monday?
Yes.
So
yes.
so that now is come up on our radar as a possible risk. Instead of a zero probability of that occurring, there's some positive probability of that occurring. So the Fed is just whipping us all over the place.
Just on that note, suppose we have another Black Friday. No, what am I saying? If suppose Black Friday is a shopping holiday.
Yeah.
It's called. I think I meant to say Monday.
Yeah. And anyway, yeah.
So suppose that were to happen,
Black
the Federal,
Monday,
what will the
Black
Federal
Monday
Reserve do?
Is a shopping day, by the way.
Well, yeah, that's one way to look at it.
We got all kinds of colors on days here. We need a colored calendar.
If the Fed sees that, will they have to react? Do they react to stock market crashes?
Yes.
Okay.
They'll react immediately. That's the fast pivot scenario I gave you.
Okay.
And where they all of a sudden they stop QT and probably reduce the federal funds rate. The other pivot would be a slow pivot as the economy goes into recession, the labor market gets weaker and weaker. Then the pivot will be slow, a more slow affair. But a crash in Wall Street, believe me, they react on an instant.
Professor, I'd like to move on to the subject of dollarization. You've been not just a proponent, but you've also been hands-on in actually enacting dollarization in several countries throughout your career. I want to talk about Argentina in particular. You've been a supporter of Javier Milei's plan to dollarize the Argentinian peso. This is a letter that you actually brought to my attention that was signed by a lot of economists in opposition of this plan. I'm going to put the letter as well as your working paper in the description below so people can read them in more detail. But I want to read this particular sentence that summarizes, I guess, the sentiment of this letter. It says, Javier Milei's economic proposals are presented as a radical departure from traditional economic thinking. However, we believe that these proposals, rooted in laissez-faire economics and involving contentious ideas like dollarization and significant reductions in government spending, are fraught with risks that make them potentially very harmful for the Argentine economy and the Argentine people. And it goes on to further outline specific problems with dollarization, such as the fact that the proposal for dollarization aims to replace the Argentine peso with the US dollar as domestic currency. Both ideas seem appealing in their simplicity and promises of a quick fix to control inflation and instability, but they do not recognize major economic realities. Okay, so is this out of touch with reality?
Oh, the letter is complete rubbish. I doubt if most of the people who signed it even read the thing. It's so absurd. It is based, it's an ideological statement. It's not a statement based on facts or economic analysis. And let me give you a few facts. They want to stick with the current system. Let's see what's going on in Argentina today. I measure the inflation rate today. I measure it every day. It's 232% per year. It's one of the highest inflation rates in the world. The peso, since January of this year, David, has lost 78.2% of its value against the greenback. The IMF outlook for 2023 is a recession, of course, of 2.5%. The economy isn't growing. At present, the money supply is growing at 115% per year. My Hanke's golden growth rate, a rate of growth consistent with hitting the inflation target in Argentina of 5%, that rate of growth is 10.5%. So the money supply is growing 10 times faster than the rate that would be consistent with hitting an inflation target. Now that's today. let's look at the history. Since these signatories of the letter clearly know nothing about the history of Argentina, they have been plagued with one crisis after another. Major crisis: 1876, 1890, 1952, 1958, 1967, 1975, 1985, 1989, 2001. And since 2001, they've been in a complete crisis all the time. Recessions. Since 1950, they've had 16 recessions in Argentina. GDP per capita has plummeted. Everybody's in poverty. It's plummeted. GDP per capita is back where it was in 1974. They're a deadbeat, a debt deadbeat. They've had 3 defaults since 2000. They're recidivists. They've gone to the IMF 22 times with 22 programs. And the source of the problem, in broad strokes, is they have Peronism, which is economic intervention, economic fascism, and they have fiscal and monetary enemy. They don't follow any laws. They just ignore the laws. And the specific source of the problem is, in fact, the central bank, the Banco Central República of Argentina, the BCRA. It has discretionary monetary policy, and it's created these crises: banking crises, recessions, economic downturns, poverty, debt defaults, you name it. And that's why you want to put the bank into a museum, mothball it, put it into a museum, and the same thing with the peso. I first actually argued this in a Wall Street Journal article. In 1989, I started advising President Menem until he ended his last term in 1999, 10-year period. And in 1991, in October, I wrote a piece in the Wall Street Journal that they should get rid of the central bank. That was way back then. So the proposal's nothing new. Then in 1999, with Kurt Schuler, I actually, at the request of Menem, drafted up a dollarization law. If they would have dollarized then in 1999, we wouldn't even be talking about this, or we wouldn't be talking about all these problems. So every time I've been involved with a dollarization or any dollarization that I'm aware of, historically, they've worked like a charm. Montenegro in 1999, I did a dollarization. It worked like a charm. 2001, Ecuador, we dollarized. It's the longest lived currency regime they've ever had in Ecuador. And it's very popular still to this day. And that's why they retain it.
Well, I don't think this letter is arguing that it hasn't worked in the past. I think it's bringing up specific examples of current economic conditions of Argentina today that may impede this plan today. I'll just read you one sentence from this letter, and I think you've addressed this as well in your working paper. It says, similarly, dollarization seems to offer a solution to Argentina's chronic inflation problem and could be tempting when the value of savings and the ability to consume are both decimated by runaway inflation. However, it says the current shortage of foreign exchange reserves would make the initial conversion rate of peso to dollars so high that it would generate further inflation. This means a decline in real wages, such as a subsequent reduction of inflation, would be achieved by a major fall in the labor share of national income. Is that true? They don't have enough reserves to make the conversion.
No. This is total rubbish. The supply of dollars in Argentina is massive. It's $265 billion of cash. Notes are in circulation. It's the second largest circulating stock of US dollar notes right behind the United States. So the circulation of there are all kinds of dollars in Argentina. They're all under the mattress and in safety deposit boxes. If you officially dollarize, those come into the market right away. And what about the exchange rate? The exchange rate, they don't understand how these markets work when you announce dollarization. Right now, there's an official rate that's artificial, and there's also a black market rate, and that rate is obviously much more depreciated than the official rate. If you announce dollarization, you'd end up with a rate somewhere in between that so-called blue rate, which is the so-called black market rate, and the official rate. You wouldn't go over the black market rate. You would appreciate relative to the current black market rate. So the economists writing this obviously have no experience in markets and have never done one of these programs. So they really, it's a case of literally signing something they maybe either haven't read, or if they've read it, they really don't understand or know what they're talking about.
I think it further assumes that Argentina needs more government intervention in its currency and monetary policy rather than less, which is what dollarization would bring. Here's one sentence. The 2008 global financial crisis showed that inadequate market regulation can have disastrous consequences. Okay, a lot of assumptions there, assuming that the 2008 crisis was caused by inadequate market intervention or regulation. Can you unpack that for us?
Well, yeah, the 2000 crisis that was caused by the Lehman bankruptcy, and the Lehman bankruptcy should have been avoided because Lehman was solvent at the time, and we had a Secretary of Treasury, Hank Paulson, who couldn't stand the CEO of Lehman, Dick Fuld, and they had a personality and personal disagreement. And so Paulson decided he'd stick it to Fuld and let Lehman fold. And that set off a huge crisis. So it was government intervention. Government intervention caused the thing. So they don't even have their facts right. Now, by the way, one of my colleagues, a distinguished economist at Johns Hopkins, Lawrence Ball, wrote an excellent book published by Princeton University Press on this topic. So if you want to read it in a whole book thing and not listen to my 1 minute soundbite on the thing, you can read Ball's book because it is definitive.
Bringing this back to Argentina, I'm guessing you disagree with the notion they need more market regulation, not less.
They must be. These people are delusional. The Peronistas. It's that the economic system run since Perón was president in Argentina it's been run by the Peronistas, and what is that? That is Italian economic fascism with Argentine characteristics. It's intervention all over the place, and there's what we call anomie, tremendous anomie in Argentina. Now, what does that mean? That means no matter what the law is, they just break the law. They just ignore the law. That's anomie. You ignore the law. So even if they have lousy laws or good laws, whatever they are, if they don't like them, they just ignore them. So it's a completely chaotic system in which you've ended up, as I said, with 3 sovereign debt defaults since the year 2000. You have to look at the facts on the ground in Argentina. Now, this is something not only I know from experience as advising President Menem, but remember in 1995, Domingo Cavallo was the economics minister, and he brought me in to assist him. So I had that experience. And also I know the markets there because I was a president of Toronto Trust in Buenos Aires, a mutual fund. And that fund in 1995, David, was the best performing fund in the world. We were #1 in the world. And why were we? Because we understood how the markets worked there.
Okay, so let's bring it back to the present situation. The Argentinian election closes on the 19th of November, so we're speaking 2 days ahead of that. Javier Milei is currently, as of a few days ago, still leading in the polls. Let's assume he wins. I'm not saying he will or won't. I don't know, but let's just assume he wins. How difficult
Well,
or
I
easy?
I don't know either. And as I said in my working paper, the last point that I raised, and I'll quote, is the following: although I have been involved in the current dollarization debate in Argentina, I am not connected with the presidential campaign of Javier Milei. That's right on page 4 of the working paper you're going to post. So anyone predicting the outcome of this election is really rolling the dice as far as I'm concerned.
But just suppose hypothetically he wins, would it be difficult to implement dollarization today?
No, it'd be very easy to implement it. It's all done in 30 days. That's the end of the story. I've done it in 2 countries, so I know I have some idea of what I'm talking about. And I have been in contact with the people who've been designing the program, and I'm convinced that they do know what they're doing and would be able to implement with due speed within roughly a 30 to maybe a 45-day period, depending on how they do it. And the details of how they do it, no one knows except them. So we're talking about hypotheticals on hypotheticals. The first hypothetical is that Milei wins. The second hypothetical is that we'd know exactly how they were going to implement dollarization. And all I'm saying is that hypothetically, if I was doing it, I know that it could be done in 30 days because I've done it before. We did it. We did it in a lot less time than that in Montenegro, believe me.
Right. Okay. So a final point I'd like to address also from this letter, side effects of potential dollarization. It says here a major reduction in government spending would increase already high levels of poverty and inequality. Assumption here being that if we were to have less government intervention, dollarization, there would be side effects to society. Is that true?
This is absolute rubbish too. What is the worst tax that impoverishes people and creates income inequality? It's the inflation tax. And as I said, I'm measuring inflation at 232% per year. To buy a pair of new blue jeans in Argentina, it takes 1/3 of a monthly minimum wage to just buy a pair of jeans. So inflation is a huge contributor to economic inequality, huge, and a huge contributor to poverty. Now, what was the other stupidity that they uttered? There was enough. So forget the inequality. Dollarization
it would increase poverty, but I guess same thing.
No, it wouldn't. It would increase prosperity, and it would reduce income inequality. And by the way, the government spending may or may not go down with dollarization. The deficit would certainly go down, and inflation would go down. But right now, if you look at Ecuador, their government spending as a percent of GDP is about what it is in Argentina, and Ecuador is dollarized. So they again
they're arguing that it would shift the burden to the working people because your subsequent reduction of inflation would be achieved by a major fall in the labor share of national income.
No, that's not true. That's false. It's just not false, because now who's financing all of this? The the inflation tax is tremendously regressive. It taxes, think of it this way, it taxes the little guy. It doesn't tax the guy with money. He's got that. Who do you think is holding the $265 billion worth of greenback notes that are in Argentina? It's not the little guy, believe me. The little guy doesn't even have a safety deposit box or a safe to put the money in, and he doesn't save anything. The little guy is forced to spend everything he earns, and everything he's spending it into this inflation, being taxed by the inflation tax. The rich guy isn't spending all of his money. He isn't being taxed by inflation. He's probably being a clever investor and making money on top of it.
Maybe there's a middle ground, and I think you've implemented this in Eastern Europe at one point, which is not officially dollarize the economy, but just make the dollar legal tender. If the little guy wants to transact in dollars, he can do that himself. He doesn't need the government telling him one way or another.
Well, you could, in fact, do what we did in Montenegro. Montenegro was part of the rump Yugoslavia. Serbia and Montenegro were what was left in the rump Yugoslavia. I was a state councilor in Montenegro and the chief advisor to the president, Milo Djukanovic. And what did we do? The legal tender in Montenegro and Serbia at that time, December 1999, it was a inflating, worthless Yugoslav dinar. So we said nothing about that. We just said that the Deutschmark would become legal tender also in Montenegro. And within a few weeks, what happened? There were no more Yugoslav dinars floating around. They disappeared fast. And the same thing would happen if you use that mechanism for dollarizing officially. You said, okay, the peso is still going to be, if you want to use it, it's legal. But if you want to use the US dollar, now it's legal tender. You can pay your taxes in it. You can use it for contracts, do whatever you want to. The peso would disappear very, very rapidly if they use the Montenegrin approach to dollarization, which you suggested. But there are other ways to do it. There are other ways to dollarize. That's one way.
Good. All right, Professor, thank you very much for shedding light on that issue and also recapping our stats. So we'll put the link in the description below. Check out Professor Hanke's working paper in response to this letter. Where else can we find your work, Professor?
Well, if you follow me on a daily basis on Twitter, it's just at Steve_Hanke, Hanke. And, I've got a healthy following. I think among the major economists, it's number 3 now, 668,000 followers and change, and ranked as the 3rd most influential economist by Focus Economics. So that's one way. But if anyone actually wants to get on my regular distribution list, they just send me an email and request that. And that email address is Hanke, Hanke, at jhu.edu.
Okay, we'll put the links down in the description below as well. Thank you very much, Professor Hanke. We didn't have much time to talk about gold, but if you want to follow Professor Hanke's gold sentiment gauge, tracks the sentiment in real time, you can subscribe to this. So we'll put a link to that as well. We can talk about that more in detail next time, as well as other current market conditions. Thank you very much, Professor.
Oh, thank you, David. Great to be with you.
Great to have you as always, and thank you for watching. I'm David Lin. Don't forget to like and subscribe.